Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. The FBI investigating a suspected terrorist attack in New Orleans and hunting for potential accomplices after a truck plows into a crowd, killing at least 15 people. Police also looking at whether a Tesla Cybertruck explosion outside the Trump Hotel in Las Vegas may be related to the New Orleans incident. We'll get analysis with Control Risks Partner Angela Mancini. Also ahead, a negative start to the trading year with Hong Kong and Chinese stocks indexes tumbling as the private factory gauge shows slow expansion. We'll discuss that and the other risks and opportunities ahead in 2025 with Bank of Singapore's global CIO, Chia. Let's get to our top story. President Biden says police are looking into any possible link between a suspected terrorist attack in New Orleans and the explosion of a Tesla Cybertruck in Las Vegas.
We're tracking the explosion of a Cybertruck outside the Trump Hotel in Las Vegas. Law enforcement and the intelligence community are investigating this as well, including whether there's any possible connection with the attack in New Orleans. Thus far, there's nothing to report on that score at this time.
For more, let's bring in our U.S. Managing Editor, Miles Miller. Miles, pretty uncanny that the two vehicles involved in the two incidents came from the same car-sharing platform, Turo.
Yeah, right now, federal investigators here in the United States are trying to figure out if that is indeed a link between the two incidents. But as we know right now, there's no definitive link between two attacks that occurred on New Year's Day in the United States, one in New Orleans that resulted in the deaths of 15 people, the other incident happening at the Trump Las Vegas hotel that resulted in the death of just one person. So as it relates to New Orleans, this pickup truck, person behind the wheel of a pickup truck driving into a crowd of people who are celebrating the new year in the French Quarter. That suspect identified as 42-year-old Army veteran Shamsud Din Jabbar. In his truck, they found an ISIS flag and multiple improvised explosive devices. And investigators believe that he may not have acted alone. Now, what does that mean? Does that mean that he acted with others in this specific attack? Or did he have help in planning this? Now, we know that the FBI and the Department of Homeland Security in the United States had been warning cities about the potential of vehicle ramming attacks. It's something that's been used by lone wolf folks who have been inspired by ISIS and by ISIS itself in numerous parts of the world. Of course, it was just a few weeks ago we saw a vehicle attack at that Christmas market in Germany, and it was something that officials here were very cautious about. And then, of course, we see it happening in New Orleans.
Well, of course, we heard from Elon Musk suggesting that perhaps this is likely to be a terrorist attack. No evidence was given. I'm just wondering, in terms of reaction from other voices, the likes of Trump, I mean, this is happening on the cusp of him becoming president. I mean, what are we hearing from him?
Yeah, we heard from him tonight. He condemned the violence and emphasized that this was very important to that we have stronger security measures in place. He actually said that this was sounding alarm about security. Obviously, the incoming president has made Homeland Security something that's really important to him. He has already put somebody in charge of the border. He's already nominated someone to run the Department of Homeland Security. He's already put forth somebody to replace the FBI director who announced he wants to leave. And then we heard from President Biden, who said the situation is fluid, but that authorities were working to determine any links between the two attacks. We know that this is going to be a major issue going forward. What are the ways that officials will secure the United States as it relates to homegrown terror and extremism? Of course, it was just a few weeks ago we heard from the former president saying that they had defeated ISIS. And then you see this attack, which they are now looking into whether or not this was inspired by ISIS. But again, an ISIS flag in the back of that pickup truck, certainly all signs pointing to homegrown terrorism.
Miles, thank you so much for that. U.S. managing editor for Bloomberg TV, Miles Miller, leading our coverage right there. Now, the sudden resurgence of suspected terrorism in the U.S. is adding to geopolitical risks and economic uncertainty already on the agenda as we enter 2025. Our next guest has issued predictions for the top 5 risks for business, along with guidance for how organizations should prepare and respond. Let's bring in Angela Mancini, partner at Control Risk. Angela, good to have you with us, and Happy New Year. Not a good way to start the year. What do you make of the incidents in the U.S.? What do you make of the timing of those incidents?
Well, you know, as your prior guest just mentioned, there's a lot still that we don't know because there are a lot of investigations still ongoing. But I think what we take away from this is the broader issue of, indeed, there are risks for businesses ahead. And we've put, as Control Risk, put down political violence as one of them. And whether that's against politicians, or whether that's against businesses, or whether that's against people, that is something that's been a really worrying trend that we've seen really coming to the fore. And there's some reasons for that. There's obviously the potential resurgence of Islamic extremist terrorisms, their terrorist ideologies. There's also the just online radicalization of people, more access to disinformation, more access also to low technology uses of weaponry. So whether that be cars, as is in the case we saw here, or we've seen in places around the world, knives or 3D printed guns and things like that. So it's a worrying trend that's driven both by the people being exposed to different ideologies, as well as the lower barriers to entry of being able to actually conduct these against soft targets.
Angela, the incidents remind us of that Christmas attack in Germany. You got to wonder whether these attacks are becoming harder to predict, becoming harder to prevent, and also, what are you looking out for in terms of signals for 2025?
Well, this is the thing. They are hard to predict. It's almost impossible to predict any specific attack, right? The other challenge that we would mention is the geopolitical rivalries have reduced the ability of governments to work together on counterterrorism operations, as they may have done more robustly after 9/11 and in those years. But we're looking at this as a key risk. From a business point of view, again, very hard to predict. So this is about duty of care, knowing where your people and your assets are, and really being prepared for a much more diverse threat landscape and more diverse threat actors. This is one of just the 5 key risks that we're looking at, in addition to dysfunction in the U.S., which is going to lead to some, obviously, national security issues, as well as business regulatory issues. We're also looking at the global trade war, mainly between the U.S. and China, red line geopolitics, and digital concentration risk for businesses as well.
So a lot of risks to be looking out for. We're also looking out for fault lines. And when it comes to relationships, nothing is more important than U.S.-China, perhaps, I mean, especially for businesses. How are you assessing that for the new year?
Well, that's a key one that we're watching, especially from here in Asia. And as you look at the incoming Trump administration, we're already seeing a lot of signals of where that administration might go. But we still don't know entirely because the advisors aren't entirely in place. And we're seeing even now fractures in the Republican Party between Elon Musk and that contingent, as well as the so-called original MAGA, and where they might actually take policies in the Trump administration. But the key things we're watching for there, obviously, are the trade war issues we saw as recently as early December, both sides increasing export controls around semiconductor chip manufacturing, as well as, in the case of China, critical mineral exports. The key thing to watch for there is, what is China's retaliation? It has a really strong, robust playbook it's built up over the past couple of years in following the first Trump administration. They do have the ability to respond much more robustly to trade restrictions than they have in the past. We're also watching for what's the impact on other countries besides the U.S. What does Europe do as it relates to China? And what do other countries do as China's exports maybe no longer go so much into the U.S., but into other countries as well? And then, of course, from a security perspective, it's what does the U.S. and China, what do they do as it relates to several regional hotspots around the region as well, which are all things, again, we have some signals from the incoming Trump administration and what he said in his campaign, but it's an America First policy. It's transactional. It's going to be changing rapidly as we expect. And so there's a lot of unknowns as we go into 2025.
A lot of unknowns, but is it fair to assume that when it comes to U.S.-China relations, it is one of managed decline with or without Musk? And for businesses, how do you counter that? I mean, can they actually control supply chains? What can they do?
You're raising great points. And indeed, while it's not, we can't predict the specifics, we definitely see the direction of travel, which is as follows. The US and China are indeed staying strategic competitors. The Biden administration policy of small yard, high fence as it relates to just having the competition on the business side be around a couple of specific areas is probably gone. We expect to see Trump's looking at tariffs around a much broader range of areas. So it is a challenge. We're not seeing a lot of companies exit the market. They're staying in China and trying to make it work. But the real question is you raise is what do businesses actually do? We're looking at helping businesses position with geopolitical resilience. So really looking at what matters to your own business footprint, operations, supply chain, market, JV partners. Some of these issues you see in the headlines actually don't apply to you. In some cases, it depends on the market you're in and who you're working with. So it's all about really looking closely at each individual corporate's footprint, supply chain, and partners, and then mapping out the different scenarios that may be underway down the road, and then really having strong monitoring across those potential triggers and really diversifying that supply chain. So that's what corporates have us on retainer for years now, is to really look at how, again, you can't predict what's going to happen in the market or between the US and China, but having that geopolitical resilience in place, having looked across your operations and be ready for what might come.
We talked about how trade is a battleground, and we know some of the countries most exposed. We talked about China, possibly Japan, even countries like Korea, for instance. I mean, what do you do if you're running a business? Do you try to avoid these countries which are most exposed to U.S.-China tensions?
Yeah, again, I think it depends first and foremost on what your business model is and what the company's actually doing. But if you are in a situation where you do have heavy exposure in sectors that are considered critical, national security issues, and we're seeing more and more of those on the rise, not just semiconductors, but remember, we're also seeing this now with biopharma, et cetera, is we would never necessarily recommend that companies think about a full exit out of a market because, again, with all this risk, there actually is opportunities. There's a lot of nationalist policies, tax rebates, incentives, and the like across a range of markets. We have a lot of clients coming to us and saying, we see huge opportunity. How do we grip it? So I think what we're looking at is, again, you map out your operations, but if you do have the ability to diversify your supply chain, you should definitely be doing it. But at a minimum, it's about really understanding what your supply chain is. What are your most critical components of what you're making or selling? What are those transit routes? Who are those partners and what is their exposure, maybe in their own national political market, et cetera? And then just having that all at the ready so that you, again, have that resilience in place if something does happen in the market, whether it be anything from a shipping route being blocked to a JV partner being swept up in a sanction to anything that we might see around export controls and trade restrictions as well.
From signs so far, Angela, no end in sight, for instance, for the tensions in the Middle East, in Ukraine. Yet, when you take a look at assumptions being made about oil prices, they're pretty much divided down the middle. Some say oil's headed up, some say oil's headed down. I mean, what are your own assumptions when it comes to that?
Well, I think when we think about the broader market in general, we're really looking at, of course, oil is a key component, along with other, we're tracking a lot of issues around critical minerals. But I think more than anything, what investors, of course, want is stability. And so we're looking at what's happening in the Middle East as it relates to possible peace processes there, Trump coming in and being close with Netanyahu and seeing if we can actually get some clarity and some resolution to the hotspots in Gaza and Lebanon, but then also more broadly what that means for business across the Middle East. You have Saudi Arabia, who's positioned itself very well as a neutral interlocutor for businesses between Europe and Asia. So that's an interesting one to watch. Clearly we're trying to look at see what is any other hotspots that may be brought to bear as it relates to commodity prices or other business risks. And with that, of course, we've got Russia and Ukraine. The risk there we see is, again, Trump's come in and said he's going to end the war on day one. We don't really know what that means. There is a risk of overspill, and there is a risk, and we see this from our clients up in the Nordics as well, as looking and seeing could that conflict spill in further west into Europe and what that might mean for, again, not just oil prices, but how you ship goods, how you ship commodities. There's a whole lot of trading route issues as well associated with these regional conflict hotspots as well.
Hang-tied Angela Mancini of Control Risks is sticking around. Still ahead this hour, we talk to the Bank of Singapore's global CIO about the top market challenges in 2025 and the challenges impending Trump tariffs might pose to China's export sector. Keep it here with us. This is Bloomberg. The global political landscape was dramatically reshaped in 2024 after several elections dealt blows to incumbents. In the UK, Keir Starmer's Labour Party won by a landslide, putting an end to 14 years of Conservative rule. Indian Prime Minister Narendra Modi and the BJP saw a narrow victory and were forced into a coalition government. All this as President-elect Donald Trump returned to the White House. Let's discuss how global leaders can work with each other. Angela Mancini, partner at Global Risk, is still with us. Angela, it was a huge year for elections in 2024. Do new leaders bring new risks? I mean, they've yet to be tried and tested when it comes to how they'll respond to issues or respond to each other.
Yeah, that's right. This is really one to watch because there's also some elections coming into 2025, which we can also discuss. But 2024 really was the year of the election. The challenge here, of course, is it was the year to kind of throw out the incumbent in most cases. And there are a lot of leaders that are new. In some cases, they have some quite significant experience. If you look at Prabowo in Indonesia, for example. But what's different now is, of course, you would have, in any case here, leaders coming in that are new and trying to find their feet and get their coalitions together. But you also have a situation where, number one, the voters are unhappy. So we've seen that pretty much everywhere. So that puts different pressures on leaders, and it puts different pressures on coalition governments, especially if voting margins were small. And it also puts pressure on, if you do have a case where you have a leader with a very strong personality that's doing more, let's say, strongman politics in the case of, let's say, Donald Trump or Prabowo in Indonesia and whatnot, how that all comes into play is also, going to be interesting to watch. But I think in sum, as these leaders get their feet under the table and start dealing with each other, the primary issues are going to be around retaining and betting in their own power. And that's going to look different in many cases than it has in the past because partisan politics is much more severe than it has been in the past. And voters are much more unhappy.
Are there certain countries which you are particularly worried about? I mean, take a look at Mexico, for instance. We've seen massive capital flight, and that has to do with a lot of friction between, for instance, the president and the judiciary. I mean, in Sri Lanka, a similar situation, some say, on the cusp of yet another crisis. How are you looking at these instances, and are there ones which you are particularly worried about?
Well, I think in instructive way, you raise good points with both Mexico and Sri Lanka. I think one interesting one to look at is Bangladesh, because in that case, you saw that wasn't an election. That was basically, Sheikh Hasina having to flee the country in the wake of domestic protests. But what's interesting there is we saw unrest, just a couple of days ago, or protests rather, in the wake of the 5-month anniversary of that issue. But what I take from that is, you have a situation where in a lot of these countries, the ones that you mentioned in particular, economies are weaker than they've been. And we know that because we've had, obviously, a lot of countries post-COVID are still struggling to get out economically, number one. Again, number two, voters are unhappy. They don't see really respite from inflation and increased cost of living issues that have come in the wake of policies post-COVID. In a lot of cases, we see the rise of the far right as it relates also to immigration policies. So there's a lot of policies on the economic side and the security side that are coming into play to make voters unhappy. And so, to your point, when you do have countries like Mexico, like Sri Lanka, maybe others that are closer to the edge as it relates to fiscal policy, debt, in the case of Sri Lanka as an issue, just, overall job growth and opportunities for the citizens, then you have a much shorter runway between where we are today and then where you might see protests, unrest, falls of government. And you see this across Europe as well. If you look at what's happening with Germany and France, I mean, again, voters are unhappy. What we take from that is economics haven't been great for those countries. There's been immigration issues and other things fueling far-right ideologies, which have then really gotten traction as it relates to the political process. And there's, again, a shorter runway between where we are today and where we might see politics go.
Do you see more civil unrest in 2025? I mean, we talked about, emerging economies like Bangladesh, but we also, as you said, we saw that in Germany, we saw that in the UK, the whole world, regardless of, the status of the economy emerging or developed, they're beginning to see more civil unrest.
Well, I do think it's an issue. I mean, it's hard to point out any specific countries that would have a much, much higher risk than others. But I think if you look at the overall trends, and this gets back to control risk, top risk for businesses in the year ahead in 2025, and if we think about things like rising political violence, redline geopolitics, the reality is, again, voters are unhappy, economic situations aren't great. And so it's going to take less of a spark to maybe get people to go to the streets. So what we're talking about with corporates is just making sure you're really across from a duty of care perspective. Where are your people, where are your assets, where are your travelers? And you've got that in hand, because it's not clear which country might have a spark to then have some kind of unrest issues. I mean, some of the, if you look way back at the Arab Spring, that was, kicked off by a pretty what we thought at the time was a small incident in Tunisia, and then that kind of spread around the region. So I think a lot of risk managers are looking at, are there areas where you could possibly see a spark and then things collide out of control? But again, if you look at Bangladesh, they had a situation where you had the leader had to flee the country in the wake of unrest and protests, but then you had a highly respected, really strong technocratic leader come in who's doing very well at trying to, shore up the country, get the economics back on track. So in some, I'd say, very hard to predict a specific location where that might happen. But indeed, the trends are worrying as it relates to all the things that would feed into the unrest around economics and social cohesion issues, and also the rise of disinformation and ideological radicalization online.
Angela, one ongoing political crisis in Asia is actually Korea. You got to wonder what this means for the Korean Peninsula, what it means for relations between Korea and the U.S., also relations between China and Russia.
Yeah, that's right. I mean, what we've seen in South Korea has just been astonishing in the last month, between the president, who's now, been impeached and there's an arrest warrant out for him, calling for martial law, and then all the uproar around that, and then now where they can't move forward really with a process to kind of wind that out and come up with new elections until they place judges on the Constitutional Court. There's only 6. They're looking to get 9 if they can before they actually make those decisions. But in some, you have a situation there where the politics in South Korea has always been volatile. They've had a lot of presidents impeached through the years. But this has been quite extraordinary, especially when you also consider the tragic incident with Jeju Air in the last few days that we saw, and also, of course, the decline of the currency, which is at its lowest levels almost since the Asian financial crisis in the 90s. But even with that, you don't see a rise of bipartisanship. It's that partisan politics. It's the idea of, let's make sure that we're keeping our own agendas flowing, right, because maybe we can get around the other person. But in some, what we'd say is, as that relates to the country in general, we don't see a big issue as it relates to the economic or security stability of South Korea.
Angela,
we think it's still in really good stead.
Angela, great insights. Angela Mancini, partner at Control Risk. Coming up, Chinese President Xi Jinping signals the world is on track to meet its GDP target. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. A private survey of China's factory activity slowed its pace of expansion in December. The Caixin number coming in at 50.5, which fell short of the average estimate. Let's bring in our China correspondent, Min Lo. Min, what's been the market reaction to the data when you take a look at, of course, the stocks and the yuan, not looking too great?
The back foot today, I believe, slipping about 1.4% this morning on the back of the weak PMI print. A sizable miss there, coming in at 50.5 versus estimates of 51.5, and this tracks the miss that we saw in the official PMI data that came out on Tuesday as well, suggesting that this uncertainty over Trump's policies are weighing on purchasing managers' decisions. Perhaps they're waiting for more clarity, and also given that we're so close to the inauguration date, which means that any shipments heading to the U.S. could by the time they reach the U.S., we could possibly see a change in U.S. policy. We're also seeing bond yields hitting a fresh record low today at 1.64%. And looking at the forecast for the services PMI from Tyson that is due next Monday as well, we're looking at a forecast of 51.4, slight slowdown from the previous month, but we did see this big beat on the official services PMI that is driven by a rebound in construction PMI, and we got those home sales data for December out today, showing that home sales remain flat compared to the previous year. That is a good sign of stabilization, given that every single month last year, except for October and December, we saw home sales in the decline. So it is showing signs of a fragile recovery in the property sector.
So on balance, a pretty mixed picture in terms of eco data. I mean, Xi Jinping, though, pretty confident. He says China will get that 2024 GDP target of around 5%.
That's right. We will get the full set of data in mid-January, but President Xi already foreshadowed that China has achieve that around 5% growth target for this year. He's really projecting this sense of confidence, especially in his New Year's Eve speech that is televised across the country, where he highlighted some of the breakthroughs that China has made, especially in its space missions, for example, in AI, in quantum computing. And of course, these are all areas where China is locked in this tech competition with the US. Geopolitically as well, he emphasized the importance of that one country, two systems model for both Hong Kong and Macau. And he talked about the inevitable reunification with the motherland of Taiwan. This comes as President Lai Ching-te also gave his own version of a New Year's speech to the Taiwanese people, vowing to step up Taiwan's defense budget and to display this resolve in fighting. And of course, against this backdrop, you have the uncertainty over Trump's policy on Taiwan, given that Trump has repeatedly said he wants Taiwan to pay the U.S. for any sort of protection. So a lot of uncertainties shaping up in the geopolitical front as well.
That's right. That seems to be the theme, uncertainty. Bloomberg's China correspondent Min Min Lo, thank you for that. Let's bring in Chia, Global CIO at Bank of Singapore, to discuss her 2025 strategy, including that of China. Jean, good to have you with us, and Happy New Year.
Happy New Year. Nice to be here.
You know, when it comes to China, I mean, we've been waiting for that turnaround. That turnaround has not come. Of course, that reassurance coming from Xi Jinping remains just words.
Well, you could say that, but I think the political rhetoric is just as important in a controlled economy like China. But I think what was stood out for me was his mentioning the endogenous as well as the exogenous factors. Endogenous factors being, you know, domestic resilience and the focus on livelihoods, and which really also points us to the fact that perhaps domestic confidence is something that needs to be fixed before we see a breakthrough in terms of the economic numbers. The PMI numbers, Min rightly points out, does express some sort of caution from the business community as well as the private sector in terms of what will happen post-tariffs. I think that's the big, elephant in the room, if you like, for a lot of the economies, both globally as well as in the US, in terms of the impact of that. So we remain optimistic on China because we do see a shift in rhetoric since September into whatever it takes sort of policy stance. And gradually, albeit more gradually than we would like, we're seeing that coming through both, on a periodic basis, but nonetheless, all incrementally very positive in terms of direction. So we actually went overweight on China from a tactical asset allocation perspective somewhere in the middle of the year, perhaps a little early, you would argue, but we think that, a lot of this uncertainty has been priced in to some extent, and now there is potential upside surprise if, the policy moves look more substantive than the market now expects, especially on the property as well as consumption front, and the ability to improve consumer sentiment, business sentiment is going to be significant.
It is a big if, though, right? Because we're assuming that more stimulus is coming, and we're just waiting for greater clarity when it comes to Trump's policy towards China. Does China actually have the tools to reverse investor sentiment and reverse the economy?
Okay, so right now, if we just zoom in on tariffs as the big issue, right? At its most extreme, of course, it's 60% tariffs and potentially rolled out earlier than one expects. For example, because tariffs can be implemented by executive order, Trump has made it very clear, that tariffs is the most beautiful word in the dictionary, whether we as wordsmiths or economists agree or not. But I think that means that it's going to be one of his top priorities in terms of at least expressing that as one of the first policy moves. If that should come through, executive order plus a consultation period, that might imply that it is a second half implementation on the tariffs. And our expectations, it's not as extreme as 60%, probably somewhere between 20 to 30%. Now that is significant in itself and could shave off about 1% of our China GDP forecast. Now, given it's a half year, we're expecting for 2025, our growth forecast for China to be cut from 4.7 to 4.2%. That's fairly significant. So on a first order perspective, the impact on MSCI China constituents is somewhat limited because actually US revenue exposure has come down over the years compared to in 2018, for instance. But on the second order effect, which is the GDP aspect, that could impact Chinese earnings growth. But to some extent, that's already been priced into the market. What the market needs now is a catalyst to know that some of the structural issues are behind us, particularly in the real estate sector. So if we do look forward to some sort of hints, right, in terms of what could be perhaps a stabilization fund of some sort to absorb some of the excess supply, that could be a catalyst for the market. So we remain hopeful, like you say, and we do think that this could be a pivotal year for China.
You talked about how you have been overweight China. What did you buy? Will you continue to buy? Is a dip a buying opportunity?
We certainly think so, especially in what we call quality yield names. That could include some of the telcos. Obviously, the companies that are less exposed to the export sector, more tuned towards domestic recovery, as well as platform companies that we think are attractively valued at this point. I think China is going through a structural phase of recalibrating its economic growth drivers away from real estate into the more high-quality, tech-driven sectors, and we see nascent shoots in terms of where that's developing. Clearly, there will be challenges in the short run, but whether in private markets as well as in the listed space, we do see opportunities there.
Are you as optimistic when it comes to the U.S. economy? Of course, we've seen massive growth for the S&P, and some say that U.S. exceptionalism will continue in 2025. Will it? And you know what? Some perhaps argue the other side. Is it a bubble? I mean, when we talk about U.S. exceptionalism, is it the same as when we talked about Japan's exceptionalism before?
So it's interesting in terms of where the U.S. stands. So Bank of Singapore, we upgraded the U.S. equity market to an overweight position on 7th of November. No coincidence. Obviously, we did think that Trump 2.0 is going to be a catalyst and very positive for the capital markets, particularly, as you mentioned, U.S. exceptionalism on the equity market growth as well as U.S. dollar. So to that extent, I think that is a positive aspect. Now, what we think is at valuations where we stand, we do still have upside from our base case, which is about 11% from here for our 12-month S&P target. But we acknowledge that the first half could be very choppy. Case in point, I think for earnings, I think this is earnings season, so guidance from the corporates would be very important in driving where we think valuations could be. But we are thinking that the first 2025 earnings growth is somewhere around 16.5%. So it's still a fairly strong earnings backdrop for companies. So re-rating upwards is still a possibility. Now, the question is, what is the risks of the Trump administration? And that's where yields could become very volatile. The backdrop in terms of whether it's tariffs, as well as taxes and immigration, all three point towards potential inflationary risks. And so from that perspective, our expectation is the Fed will start to pace its rate cut trajectory, and that is going to be an adjustment period. So our 10-year yield forecast is on a 12-month basis is 5%. That can be adding a lot of volatility to the fixed income market for one, and clearly also for the equity market. So,
in terms of the equity market, do you see a broadening of the market? Will it go beyond the Mag 7? I mean, some say that, right now, given where valuations are, perhaps you should be looking at the small caps.
Yeah, I think there is a broadening out, and we have seen that already in the 493 stocks, if you like, of the S&P 500. But one has to be very selective. I think within that space, there are also vulnerabilities in the market, and we've seen, some of the latest news flow on credit card issues, etc. So I think there are definitely going to be winners and losers if interest rates don't get cut, and we see a higher resting rate in terms of inflation, as well as potentially rates staying around the 4% mark. So that could still be, we see some vulnerabilities. But broadly speaking, if growth is intact and we see the tax cuts being maintained, that's broadly speaking really an expansionary policy for the US, and earnings growth and productivity gains, more importantly, could be the driver of the markets as well, all the way into the small and medium enterprises.
The thing is, the Fed is likely to be a driver as well, and it does seem to some people that the market's underpricing the risk of the Fed staying pat for a very long time or even raising rates. What's your view on that?
Yeah, so absolutely. I think our chief economist, Manso, has been spot on in terms of how he's been forecasting where the rate trajectory could be. And we have turned cautious and raising our 10-year forecast from 3.75 to 4.25 to 5, actually what seemed punchy at the time. But now, with yields where they are, it doesn't seem all so far-fetched. That just goes to show that there is a vulnerability, particularly because the fiscal deficit is on the high side, and that could investors will exercise some caution in the long end of the curve. So that exactly will create some of the volatility in terms of fixed income. So that's not to write off fixed income altogether. I mean, right now we are overweight equities over fixed income as a preference. But there is still a lot of rich yields to be had. It's just that during this period, because duration will drive some of the performance, and the volatility could be here to stay for fixed income.
So still a 60-40 portfolio?
To some extent, no, yes, but we basically believe that there is a very, very important decision that has to be made by investors today, which is to look and zoom out from the near term and look at the longer term. And in that context, portfolio construction, whether it's the addition of alternatives, gold, as the diversifiers, and also to add ballast to the portfolios is incredibly important. We've done a lot of studies, our portfolio strategists, as well as the team, done a lot of analysis on long-term trends. And we think this is a pivotal year where you see a rate movement as well as the sort of multilateralism falling apart that could have a very significant impact on idiosyncratic issues with equities and fixed income at the single stock and single security level. So it's very important for us to look at asset allocation as a way to manage this risk. We can't avoid risk, right? We're in this market, but one way is to ensure that the portfolios are properly diversified.
Finally, go for gold. Jean, hang tight. Jean Chia, Global CIO at Bank of Singapore, is sticking with us for more. Still to come, Singapore's economy performed better than expected last year, but Prime Minister Lawrence Wong is warning about a more complex global environment ahead. A closer look. Keep it here with us. This is Bloomberg. Well, Singapore is in focus after its fourth quarter and full-year GDP growth beat estimates. Economists think this provides scope for the MAS to loosen monetary settings, though Singapore's economic resilience will likely be tested by a complex global environment this year. Avril Hong is here with more on the outlook. Not a bad way to kick off 2025. Good news. Yeah, it's heartening to see the economic resilience of this trade-reliant nation. So for the full year, 2024, we saw it at the fastest pace of growth in 3 years. Even if you look at the fourth quarter advanced estimates, the on-year, much better than expected. The on-quarter defied expectations of a contraction. So all in looks like an economy that's on pretty solid footing to deal with the trials and tribulations of 2025. Flip the board, because indeed, some of the global risks are what the Prime Minister Lawrence Wong highlighted, saying that Singapore is not immune to some of these global mood shifts. If you look at the forecast for this year, it didn't release anything in terms of projections for 2025 this time around, but as recently as November, it said it sees growth between 1% to 3%. We have the likes of Bloomberg Economics saying that we see 2.5% expansion for this year. Now, I'll flip the board. I also wanted to rate through what we're seeing in the currency, because we are seeing the Sing dollar today sitting a bit stronger. Still fairly weak levels at 136, but moving a bit lower against the backdrop of those growth numbers. And in terms of the monetary policy expectations, we have the likes of Bloomberg Intelligence saying that the more challenging the outlook, the higher the odds that we see MAS start to reduce the pace of appreciation of the Sing dollar versus the currencies of its other trading peers. And remember, Singapore is in a bit of a sweet spot. Not only is growth holding up, but if you look at inflation, core, headline, they're both below 2%. So perhaps figuring into the equation for the central bank as well.
That's right. Inflation at about 2%. Yet, when you speak to some people, April, they say they are feeling rather squeezed and that prices may just be a bit high. Let's get back to Chia, Global CIO at Bank of Singapore. What do you make of Singapore's outlook, I suppose? I mean, given the uncertainties in, the trading environment, for example, I mean, Singapore could be in a very vulnerable position.
It's heartening to see the numbers, I think, for in terms of GDP numbers for the year. But looking ahead, as we have all rightly discussed, that Singapore is very externally exposed, and if growth in the US or in China particularly, as one of the trading partners, it will definitely impact the Singapore economy. Now, we look forward to the budget announcement very soon, on the 18th of February. And although, market observers are all expecting a very friendly SG60 budget, which
ahead of the elections.
I think we can expect more social and also sort of cost of living adjustments in terms of whether it's vouchers or other sorts of means to alleviate some of the concerns on cost of living. That's one. But what we hope to see in terms of the business community is also some of the measures to support Singapore's longer-term competitiveness and growth. I think those are areas that Singapore certainly is in a very sweet spot for capturing some of the issues that we are seeing on the geopolitical front, and that will be a unique opportunity for Singapore to also recreate engines of growth, whether it's in terms of AI, ESG, sustainability, etc. So I do, remain very optimistic. Just to debunk the myth that Singapore market is very boring, it has actually turned out a 17% return for this year. And I think
that's mainly driven by financials, though, right? The question is really whether or not that pace of growth, that pace of increase can continue in 2025.
Clearly, it is an issue in terms of the depth of the market. We do hope to see more capital markets reform as well in terms of, broadening of the equity market for many of the growth industries to also list on the market. I think that will be one issue that we will be looking at as well. But to be fair to the Singapore market, I think there are certainly high quality companies. Even though we have, for example, a large chunk in the financials, there's also the REITs market, which is going through a tough patch because of the interest rate sensitivity of the sector. But clearly, there are also some very strong companies within that sector. And we do think that depth of market will continue to improve if we see more measures to improve the liquidity as well as the listing environment for the Singapore Exchange.
Are you optimistic we'll see these measures within 2025, or will it take longer? Because the reason I'm asking is because, Singapore's competing even with the likes of Malaysia, with Thailand, Indonesia, and when it comes to IPOs that we see in the country, it's been pretty minimal.
I agree that, Singapore is also in a very unique position if we can do things right to really also harness the growth of the ASEAN region and play a role in terms of a venue for access into the markets. I think the overhang on Asia in general, and also particularly EM Asia, will be currencies. So the dollar strength is going to put some pressure on the region. But on the other hand, if we see, a moderation in terms of the US dollar, we do think that EM Asia still offers a lot of interesting opportunities, and Singapore plays a part in that broader dynamic.
So it is still a risk-on environment for you when you talk about, still believing in the story of emerging markets here in this part of the world.
Yeah, I think from the EM Asia perspective, where we see the region benefiting is this really diversification of supply chains. We're seeing FDIs pick up in many of the ASEAN countries, and I think that's a critical part of where future growth could come from in terms of ASEAN.
So Vietnam, Malaysia?
Yes. So it's not as investable in some of the markets, for example, Vietnam, but we do see opportunities, and we're seeking opportunities for more of maybe opportunities in private markets, and also the broader proxy companies that have exposure in some of these markets. This is really a bottom-up exercise. I think this is an interesting and important time to do deep research on companies across emerging markets. Like, just to give you an example, fixed income as well from the issuer's point of view. We're also doing research in, for example, Latin America, as well as EMEA, Middle East, and that does help us to diversify our overall exposure on our portfolios. So I think it's increasingly important for investors to really take the long view. One of the things I mentioned to our investors, which is very important, is also looking at structural trends. And some of these structural trends may take time to play out, but it's very, very important to look at, for example, demographics, as well as systematic changes in terms of technology like AI, and how companies, as well as even sovereigns, countries, are tapping AI to improve productivity levels. And so these are enduring trends that may not play out in the quarter and the year, but this is a juncture where you start to build portfolios with exposure to these structural trends, which in Bank of Singapore we call the super trends. And that's been a very exciting area of deep work that we're doing to improve our resilience of our portfolios.
Jean, you've been pretty optimistic about the prospects for 2025. What is the biggest risk for you for markets?
I think the biggest risk now is inflation rears its ugly head again.
And how are you assessing the likelihood of that happening?
So it really, we look at several aspects. First of all, from the US perspective, where US policy lands in terms of tariffs will have also retaliation, risk of retaliations from the other countries, say China and Europe, for instance. That could add inflationary pressure if China, for example, chooses to withdraw some of the benefits for companies such as the export tax rebates, and concurrently that could be exporting inflation into US if that's passed on to US corporates, for instance, or US consumers. So there is a risk that inflation comes back in that respect. Immigration, of course, does have some impact on the US labor market, and that is another risk that we see. But to the extent that that's supported from a structural perspective by growth and the ability to absorb some of these inflationary forces and avert potentially a rate hike this year, I think that's still a relatively benign environment for equities.
All right, Jean, great stuff. Jean Chia, Global CIO at Bank of Singapore. Before we go, here's a look at tomorrow's program. Yardeni Research President Ed Yardeni will be joining us. Keep it here with us. This is Bloomberg.